Hi, this is Tom Olszewski with Team Olszewski and Caldwell Banker with the August 2019 Southwest Riverside County Monthly Market Report. And as always, we're going to start with the recent news. So last week, the stock market had an adjustment. So it probably had an effect on your portfolio of stocks. But what, if any effect, will it have on the real estate market here in Southwest Riverside County? Should I sell? Should I buy? Should I run? The quick, easy answer, as the experts see it, is there is no immediate need to worry. Definitely no need to worry for now. So let's look at the details behind what the experts are saying. One of the things we're going to talk about right from the beginning here is the good possibility we're going to have a recession in the next 18 months. Now, I know we've talked about that in a few of the last couple of Team Olszewski market updates, but we have to realize with the Democratic debate starting, with the economy doing as well as it is, with there being question marks about whether the economy will still do well. For example, the Fed just lowered the interest rate again because there were some concerns in the mind. I think we're going to see more and more, hear more and more talk about, is the economy faltering? And I think that word recession is going to keep coming up and up. So if you have been thinking about buying or selling in the Temecula Valley, I want you to be prepared for it. Now, the main reason that there will be a lot of talk about it is there have been 4 major surveys so far this year. One by the Wall Street Journal, one by Duke University, go Dukies, one by the National Association of Business Economists, and one by Pulseonomics, who surveys a little over 100 market analysts. And they each asked the question in their survey: when will the next U.S. recession begin? Here's a graph of the results of all 4 surveys, so you have a feeling for what each survey said. Now, to make it simple, what we did is we took all 4 years, all 4 time elements, and we combined them, all the people who thought at one point in time, and divided by 4. Meaning, here's really the combined number of each year as a percentage of respondents to all 4 surveys. So 21% believe that we're going to have a recession sometimes before this year is over. Another 46% believe we're going to have a recession sometime next year. And then it goes on to 2021 and after 2021. So the reason we're giving you this right now is we have to see that 67%, 2 out of 3 of all the people surveyed in all 4 of those surveys said that we're gonna come across a recession between now and the end of next year. And let's not forget what next year is. It's a presidential election year. Probably the most contested presidential election in our nation's history. So there's going to be a lot of debate, a lot of animosity being served up by both sides. And there's going to be a lot of questioning over the economy. Why is it good? And why is it about to come apart? That's going to be part of the political rhetoric over the next year or so. So get used to it. So will this be a repeat of 2008? Not really. But I want to point out 2 different quotes from last year when they did a study and looked back on 2008. On the 10-year anniversary of the crash of 2008, they looked back at it and they said, what were the major challenges that happened in 2008 to cause the whole economy to crash? The worldwide economy to come to its knees. First of all, Ben Bernanke last year my results do suggest that in the absence of the panic, the declines in employment, consumption, and output at the early stages of the Great Recession would have been significantly less severe. So Ben Bernanke is saying if people didn't panic, 2008 would have been nowhere near as bad as it actually wound up being. And the second quote I have is from Warren Buffett. In a 2018 Wall Street Journal interview, again looking back at 2008, 10 years later, and his quote is, "Fear spread like a tsunami in 2008. So what are we saying? Well, the word recession is going to come up. People are going to think about what happened in 2008 and equate it to now. And that's going to cause a panic if we let that happen. And that panic, again, it won't be as bad as 2008, but it'll be worse than it needs to be if we don't control the panic. So we want you to be right on top of that. Remember, recession does not equal a housing crisis. And that's not me just saying that. Let's go to the Merriam-Webster dictionary and look up the definition of the word recession. A period of temporarily economic decline during which trade and industrial activities are reduced, generally defined by a fall in the GDP in 2 successive quarters. Now, why are so many experts predicting that we'll have a recession in the next 18 months? Well, let's take a look. We're now in the longest recovery in American history. So of course, there's going to be a slowdown coming. Slowdowns are just part of the U.S. economic cycles that have been happening for decades. Of course, we're not going to be able to keep on going with this recovery forever. So they do believe there's going to be a slowdown. And that's all that means, is that the GDP will slow down. However, do not equate the word recession to a housing crisis and think we're going to have the same results of what happened in 2008. But I've shown you this graph several times now over the last couple of months. This chart will show you that in the last recession, prices dropped 19.7%. But if we look at the 4 previous recessions, 3 of the 4 times prices went up. 2 of those 3 times they went up almost double the normal historical average. And the other time that it dropped, prices dropped. They dropped by less than 2%. This is so very important to understand. So the fear that 2008 is going to happen all over again because the word recession is applied, we can show you that's not the case. Now remember, we talked about 4 surveys. The most current survey, which was just done a couple of weeks ago, was the Pulseonomics survey of analysts. And they asked them, when will the next U.S. recession begin? And on that, just one survey, 59%, 9% in 2019, 50% in 2020 said that it's going to happen in the next 18 months. So what we're looking at is 59% said yes, the recession's coming. But what wasn't reported in the news is that on that same day, on that same survey to those same exact analysts, they asked other questions. One question was, what was going to trigger? And here are the top 3 answers that they came back with. The top 3 triggers, according to that same exact survey that projected a recession was coming. This is what they said. Number 1 trigger is probably going to be trade policy. Have we not been dealing with Chinese tariffs? Number 2, there could be a stock market correction. Aha! This is what happened last week. And number 3, geopolitical crisis. That hasn't happened yet. When they looked for a housing slowdown, because that did come up, some people did pick it was all the way down at number 9. So there were 8 things that were going to happen that were going to trigger the recession before they even got to a housing slowdown. So again, in 2008, the housing slowdown, the situation in the mortgage industry caused that recession. This year, real estate is not even in the top 8 reasons that a recession might take place. Again, those same people, that same day, on that same survey, also projected where prices are going to be over the next 5 years. They think this year they're going to finish up with a 4.1% appreciation. That appreciation is going to slow up over the next 2 years, and then it's going to come back and recover to normal historical appreciations, which is somewhere between 3.5% and 4% on an annual basis. The most important thing is that the same people that projected the recession was coming also said prices are not going to depreciate. Appreciation is going to decelerate, but prices are still going to go up. So the crash that we saw in 2008, the people actually predicting the recession are saying we're not going to see that again. All we're going to see is a slowdown in the amount of percentage that homes are going up, not that they're going to depreciate. And Morgan Housel, a well-renowned financial analyst, I like what he said. An interesting thing is the widespread assumption that the next recession will be as bad as 2008. Natural to think that way, but statistically highly unlikely. Could it be over before you realized it began? Let's hope he's right. Let's hope, unlike 2008, where the plane crashed, this time the pilot can bring it down and land and have such a soft landing we don't even feel the wheels hit the ground. If we look at the home ownership rate in the third quarter of 2018 and the fourth quarter of 2018, the numbers went up. Then last year, at the end of last year, when interest rates went up and people started worrying about it, that percentage of home ownership dropped slightly. Now, again, there's no challenge overall, because if we go all the way back to 1996, we can see that it shot up, going into a big boom. Then it fell like a rock after that, and it's been recovering the last couple of years. So this minor blip, this minor decrease, isn't anything to worry about unless you understand the details. As we always say, concern causes fear. Fear can cause paralysis. With detailed information like I'm providing about the situation, my goal is to take the fear away by handling your concerns. And we have to do that as far as talk of recessions taking place. The other thing that we want to discuss this month is affordability, because there was a recent survey done by CoreLogic that showed that affordability in people's minds was the leading obstacle to home ownership. It's no longer down payment. It's no longer all those other things. The number one obstacle to home ownership by the survey was affordability. And that number jumped dramatically from 2018 to 2019. It went from a little over 30% all the way up to 40%. And it's again the number one obstacle in buyers' minds. Now, I get it that people are talking about affordability, especially here in California. I get it that people are saying, well, affordability is not where it was 10 years ago. But we have to remember, 10 years ago, interest rates right after the housing bust dropped to all-time lows and prices dropped dramatically. So very obviously, affordability then was better than it is now. If we take a look at affordability going all the way back to when the National Association of Realtors first started recording it, we can see that if we go all the way back to 1990 and we look at today's affordability, and by the way, this graph, the higher the graph, the more affordable the homes are. The higher the graph, the more affordable homes are. We can see that today's affordability index is nowhere near where it was during the years when distressed properties dominated the market, the red bars. But if we go before that, if we go back to 2007, 2008, all the way back to 1990, it's more affordable today to buy a home than it was in the 1990s and all through the 2000s, right up until the crash. So yes, it's not as affordable as when the houses were cheapest in some ways in American history, certainly here in Southwest Riverside County, but it's more affordable than normal markets that preceded the boom and the crash. And I think it's important that you understand that. As a matter of fact, CoreLogic came out with their typical mortgage payment. And they said the typical mortgage payment, adjusted for inflation that buyers commit to now, and they take a look at it from January 2000, they look at it in June 2006 at the height of the boom. They look at it in February 2012 at the bottom of the crash, and what has been since then and what they projected to be March of 2020. And what they can see is that the typical mortgage payment, though above where it was in February of 2012 at the bottom of the crash, is better not only than what it was during the height of the boom, but it was better than what it was prior to the boom in January of 2000. Adjusted for inflation, today's typical mortgage payment is less than and what is projected to be this time next year or March of next year is still lower than what it was in January of 2000. And part of the reason for that is wages are going up and interest rates, though not where they were in 2012, are still lower. So another thing that the National Association of Realtors does is they list every month the typical mortgage payment as a percentage of income. And we can see that since June of last year, for the last 12 months, it has been falling. And now it's jumping somewhere between 16 and 16.75%, but a drop from 18.2%. But probably the best thing about that, historically before the boom and the bust, what's happened since, historically, the percentage of your income that goes to a house, a mortgage payment, was 21.2%. So that 16.6% today were much lower than what the historical norm was. And we have to make sure that you understand that because all they're looking at is that prices continue to go up. And they're saying, well, if prices are going up, then it's got to be less affordable. Well, no. As Mark Fleming, First American's chief economist, explained, when demand increases for a scarce supply, limited or low supply, good prices will rise faster. The difference between houses and other goods is that we buy them with a mortgage. We buy homes with a mortgage. So it's not the actual price that matters, but the price relative to the purchasing power, meaning that when we put in wages, when we put in the mortgage rate, and we put in the price, what percentage of the amount of money you make goes to your mortgage payment. And as we have just shown you, that number has dropped dramatically and is much lower than the historic norm. And the reason for that is that 30-year fixed rate mortgage rate has dropped almost a full point in the last 8 months from 4.75% to 3.75%. And going back, Mark Fleming, the chief economist at First, here's an interesting tidbit. If the 30-year fixed rate mortgage declines just a fraction more, and some people are projecting that to happen, consumer house buying power could reach its highest level in almost 20 years. So not only is affordability not a challenge now, there are certain markets where prices are way up. And I understand that. But we're talking about overall in the country. Not only is affordability not a challenge, it might be the best it's been in 20 years if the interest rates just drop a little bit more. And that's big. So when we're talking about everything here, please make sure that you understand a recession may well be on its way, but it should not have an effect on home values, and that homes are extremely affordable at this point in time. If anyone is interested, I can provide all of the details on the sources if you want to do additional research for this information, as these people are a lot smarter than me with regards to the economy. So the bottom line, as I see it from the experts, there is no need to panic with regards to the real estate market. It's still a good time to upsize or downsize or buy that first home, as affordability is great and home values are expected to increase over the next couple of years. Great investment. This is Tom Olszewski with Team Olszewski and Coldwell Banker signing out. Make it a great day.